The recent surge in U.S. home prices is unprecedented. The U.S. housing market has gone through several boom and bust cycles over the past 2 decades. Home prices rose rapidly in the early 2000s, eventually leading to the housing bubble bursting in 2008. In the years before the pandemic, home prices had risen steadily due to a combination of strong economic growth, low unemployment, and historically low interest rates. However, the onset of the COVID-19 pandemic in early 2020 caused significant disruption. Despite initial fears of a market collapse, home prices have soared due to a variety of factors, including pent-up demand, changes in housing preferences, and low inventory levels. Zillow's report released on July 25, 2024 provides a comprehensive overview of recent trends in home prices across the United States. The report shows that 237 cities have seen home prices increase by more than $1 million since the start of the pandemic, compared with 84 cities in 2019. Price increases were most significant in California, New York, New Jersey, Florida, and Massachusetts, reflecting strong demand and limited supply in these areas. Prices in smaller, less urbanized areas have also risen significantly due to an influx of remote workers seeking more affordable and spacious living conditions. Prices for new homes in particular have been rising, making it increasingly difficult for first-time buyers to enter the market. The dramatic rise in home prices has created an affordability crisis that affects large swaths of the U.S. population. Housing affordability is typically measured as the percentage of a household's income that is spent on housing costs. The generally accepted standard is that housing expenses should not exceed 30% of household income. However, this standard is increasingly difficult to meet in many areas of the United States, especially high-need urban areas. The National Association of Realtors offers an affordability index that takes into account median household income, median home price, and current mortgage rates. Data shows affordability has fallen significantly in recent years, with many households spending most of their income on housing. First-time home buyers are one of the groups hardest hit by the affordability crisis. By June 2024, the median price of an existing home will reach $426,000, with many young people and families finding themselves priced out of the market. As home prices rise, it becomes increasingly difficult to accumulate enough for a down payment. Many first-time homebuyers lack the savings or access to home wealth required for a large down payment. Fierce competition for new homes has pushed up prices and reduced inventory for first-time buyers. Investors and high-income buyers often outbid them, making it more difficult to buy a home. The affordability crisis has also led to a shift in housing tenure, with more people turning to renting as a viable option. However, the rental market is not immune to the pressure of rising housing prices. As more people choose to rent, demand for rental properties increases, causing rents to rise. This makes it increasingly difficult for many families to afford rent. Homeownership has historically been a key driver of wealth accumulation. The shift to renting could impact the long-term financial stability and wealth creation of many families. Recent increases in mortgage rates have had a significant impact on the housing market. Higher interest rates increase borrowing costs, making monthly mortgage payments more expensive. This reduces the purchasing power of potential homebuyers. Rising interest rates cause homeownership rates to decline because fewer people can afford to buy a home. This could exacerbate the affordability crisis, especially for first-time home buyers. Areas like California and New York, where housing prices are already high, are particularly affected by rising interest rates. The additional cost burden makes it more difficult for residents to buy a home. The COVID-19 pandemic has significantly changed housing demand patterns. The shift to remote work has led many people to move from urban centers to suburban and rural areas. This drives up demand and prices in previously cheaper areas. Many people are moving to areas with lower costs of living and more space. States such as Texas, Arizona, and Florida have experienced significant population growth, pushing up home prices. The epidemic has wreaked havoc on global supply chains, with shortages of key materials such as lumber, steel, and concrete leading to increased costs and delays in construction projects. This limits the supply of new homes and causes prices to rise. The construction industry faces labor shortages due to health concerns, lockdowns, and other pandemic-related factors. This slows the pace of new housing development and increases costs. Supply chain issues are further exacerbated by transportation and logistics disruptions, making it difficult to source and deliver construction materials on time. Many families have suffered a loss of income due to layoffs, reduced working hours, and business closures. This affects their ability to afford housing. Looking ahead, the U.S. real estate market faces continued challenges and uncertainty. While home prices may stabilize or decline slightly in some areas, they may continue to rise in other areas as demand continues to grow and supply is limited.